Are you still wondering which inventory valuation method is best for your company? First in, first out, or moving average? In this video, we will dive into the differences between first in, first out and moving average and how they impact your bottom line. At the end of the videos, you will walk away with a clear understanding which method is best suited for your business. So let's dive right in. Thank you for tuning in. Today we are talking about first in, first out and moving average. This is one of the popular topics among retailers. But don't worry, nothing technical today, okay? Although we will go through some calculations, but nothing technical. I wanted to share with you from the business perspective because I find that it is very important for business owner to understand or managers to understand, because sometimes there will be people who says that first in, first out is the only way, is the best and the accurate ways. But there will be some who says that moving average is the way to go. So which we will find out later. So what we're going to do today is I'm going to share with you some foundations informations about inventory management, and then later on I will share with you my verdict, which method is best suited for which type of business. And we will go into details in terms of the examples, all right? And then we will wrap it up. I find inventory management is a very important topic because this directly affect the profit of the companies. So I've actually prepared quite a number of the inventory management videos for you. So don't forget to subscribe to the channel so that you will receive notification when the video is up. So without further ado, let's get the ball rolling. Bill Gates once said, "The inventory, the value of my company walks out the door every evening." That shows how important it is for us to be able to manage our inventory properly. All right, every inventory is our company's asset. Okay, now why? Okay, let's start with why first. Why there's different inventory valuation? What do you think? Which inventory valuations that you are using for your business? Is it first in, first out, or is it moving average, or is it other way that you find it is best to manage your inventory? You can comment below, then we can check it out. Now, the reason is because there is a different perspective of COGS and closing stock value. Okay, different valuation method actually has a different views of cost of goods sold and closing stock value. Later we will see it. Okay, now whichever method that you are using, the goal of the stock valuation is, first, we want to make sure that the company's asset function in the most efficient way. That's why choosing the right valuation method helps you to maximize profit. Okay. Next is the value of the company's asset accurately reflects in your financial statements. This is also very important because I think in terms of the valuations, we are dealing with opening and closing stocks value. We are also dealing with COGS, cost of goods sold. Later I will share with you in more details. So these are the important things or factors that will affect your financial reports directly. It doesn't change your total purchases, meaning that when we talk about the first in, first out method or moving average method, we are talking about how we evaluate your stock, especially your closing stock, and how we come up with the value of your cost of goods sold. So it doesn't make any difference for your total purchase. When you spend $1,000 buying from your supplier, this $1,000 will not change just because you use different stock valuation method. So like what I mentioned just now, it affects the COGS and your closing stock values. The fourth one, it impacts your P&L and balance sheet. Let's take a look at this Apple's profit and loss. This is the last quarters that they reported the earnings. So if you look at the underlying sections, which is the cost of sales, under the product, this is what is reported, 60,765 millions, okay, in millions. So you can see that actually in the December versus the last year. This year they did slightly lesser. Okay, actually quite a lot. So their sales dropping for the last quarter, but it's still considered very good. Okay, given the economic situations. Now, so this is the ones that we are going to track. Okay, later on you will see how we derive from different using different methods. The next one is that the balance sheets. Okay, so what you are seeing over here, the one that is underlined is the inventory. So this is their closing stock value. So if you see from here, when you have high cost of goods sold, that means your cost is going up higher. That will affect your profit. Look at here, if you have a lot of inventory, a lot of balance, that will affect your balance sheets, isn't it? All right. So moving on, give it an example. Calvin buys $1,000 worth of item A. Then afterwards, I sell 600 item A for 1,002. I've made a profit. So what is the profit? The profit equals to my sales minus my cost of goods sold, which is 600, and my profit is 600. But I still have some balance stock available, which is the 400. So today, when we talk about first in, first out and moving average, we are talking about how do we come out with this closing stock value $400, whether using first in, first out method or moving average method. Let me share with you a little bit about first in, first out. For those of you who are not so sure what is first in, first out, first in, first out means that whatever that I buy first, I sell first. This is how I track my inventory. As well, for the moving average is I've actually averaged out the total cost with the total quantity of my purchases, and then I will then times the balance stock value. Then it comes the closing stock value. So this is the difference. Now let me give you my verdict. Okay, so this what I feel after so many years of looking at different types of business using different forms of calculations. This is what I find it's applicable. Okay, so first, if you have a fast moving inventory and your cost has very low fluctuations, either method it works fine for you. Okay, so when I say fast moving, we are talking about days and weeks, and sometimes you can, I mean, if you want to say months, but I think when we talk about fast moving, it's usually in days or in weeks. You can clear your stock very fast. Okay, so either way, it works perfectly fine. The next one is fast moving, but high fluctuations in terms of the stock value. So in this situation, if you can move your inventory very fast, but your costing is a little bit fluctuating, okay, on high fluctuations, we are talking about 15-20% fluctuations of high, then in that case, I would recommend that you use moving average instead of first in, first out. Okay, so we'll explore why. I'll show you later on why do I say this. Okay, so you will see the difference. The next one is if you have slow moving stocks, we are talking about months or even years sometimes, that your stock movement is pretty much slow, and you have a low fluctuations of your inventory. Actually, in this case, I think both are fine. But again, if you really want to pick one that is better, I would think that moving average would be better. Later on, I'll show you why. Okay. Next, if you have slow moving inventory but high fluctuation cost, the best is still moving average. Why? Because if you use first in, first out, you will get a wrong COGS impression. Okay, later I'll share with you in details. Lastly, we have fixed costs. No problem. Either way, it will work. Okay, fixed costs, it doesn't matter whether it's first in, first out or moving average, both works fine. Okay, so this is what I find my recommendations, which type of costing method is best suited for which type of inventory trend, I would say. Okay, now next I will go into the example. Okay, so I've prepared some example. As I mentioned, the download links is in the descriptions. You can download and we can go through this together so that we can learn together as well. Okay, now so over here on the left you will see that, and these are all the transactions. Okay, so if I'm going to open a business, and then for my opening stock balance, it's 0. Okay, so on the 1st of the February, I've actually made some purchase on my unit. So this is 10 quantity, and then the unit cost is $5.50, and total amount, of course, we will have $55, and this is my balance stock. So you will see from here, all the highlighted ones are all the purchases, and these are all formulated. So you can actually use different amount. So from here, these are all the informations that I have used the simple formula. So when you change it, you can see the difference on the right. So on the right, you can see from here is the first in first out and the moving average differences. Okay, now as I said, I'm not going to into very technical details, but I will go through with you. So let's go through this. Okay, so at the end of the day, when I total up, my total purchase is 1110. Okay, and my total sales is 1350, and this is my balance. Okay, so same thing. So this is my total profit. So I will have a profit of $243.60 if I sell all these goods. Okay, and with all this information. Now let's take a look at how we actually compute all these informations. Okay, now first day, maybe I'll just go through from the first in first out first. Okay, now first day, when I purchased 10 at a unit cost of $5.50, I left with 10. So my COGS is 0 because I have not made any sales. So in this case, let's take a look at the closing stock value. Obviously it is $55 because this is what I have. The next day, when I sold 4, okay, when I sold 4, my balance stock become 6, and my selling price is $8, and this is what I earn. If I'm using at first in first out method, what is gonna happen? This is my COGS because I sold 4, and where does the cost come from? My previous purchase. I'm still using the first purchase, $5.50. So my previous purchase times the quantity equals to my cost of goods sold. At the same time, I will have a remaining balance of 6 quantity left. And how much does that cost? Same thing, $5.50. All right. So that is how I get my closing stock. The next day, I have another purchase. And this round, even though I purchased more, my cost increased for whatever reason, inflations or logistics or just supply demands. Okay, now what happened is that this is what I paid for, 130 plus my balance stock with the previous 550 at the unit cost 550. That becomes my closing stock value. So at this point of time, my COGS is still at 0 because I've not made any sales. Now next, we have a sales coming. Okay, this day the sales not so good. I only sold 1, but this one I actually take from the cost from the previous 6, so I still go back to 550, and my balance is the opening stock and then minus my COGS. That is my closing stock. So all this you can do the own calculations, okay, on your own. So I won't bore you with all the details line by line. By then you will probably fall asleep, or you will probably close the video and move on to the next video. Now let's move on to moving average. Now moving average, when we started, okay, when we first started, it's pretty much the same because this is what I have with 550. this is my average cost. So when it comes to moving average, what we need to do is that we first need to calculate the average cost first. Okay, now average cost, it's whatever that you have divided by the total quantity. All right, so in this case I only have 55, and then the next day I made a sales of 4. So remember, sales 4 quantity. Okay, so for quantity, what happened is my COGS. So my COGS actually is the average cost times the sales quantity. That gives me my COGS. Same as my first in, first out, because this is the first few transactions, there's no difference. Okay, now the difference will come when I have the next purchase. So in this case, my next purchase is another 20 quantity at 650. So at this point of time, what happened is that I want to have my total purchase. Okay, total purchase, which is my $55. Okay, let me show you so that you get a better idea. Okay, now, so it is over here, my total purchase, okay, plus the N5. Where is my N5? N5 is my closing stock value, okay, which is 33. Okay, then divide by total quantity, balance stock 26. Okay, so I need to divide by 26. Why not 30? Because I already sold 4. Okay, so that's why we call this moving average. Okay, so this is very important, because if I would have this divide by 30, I'll get a different value, and the whole thing will go on haywire. That's why sometimes when we say average cost, sometimes people will mistaken. Average cost is not accurate, because they think that I take the total divide by the total quantity, but it is actually not. But I only divide by my balance stock. Okay, now this is my closing stock value. Very easy. The balance stock multiply by the average cost. That gives me my balance stock. Okay, let's get one more. So let's say, example, at this point of time, okay, 6th of February, I have another purchase coming in. At this time, I managed to negotiate with my suppliers to give me a very good price, $5. Okay, so I purchased 50, give me a good discount, and then my balance stock at this point is 60 quantity. Now, what happened is, over here, same thing. I will take what I have, divide by the balance, okay, to come up with the average cost. So I have to divide by my balance. I don't divide by all the total balance, the total quantity. Okay, now this is very accurate, because if you can see from here, whenever my costs shoot up, my average cost goes up too. When my unit cost come down, my average cost comes down as well. But you don't get this in the first in, first out, because it always assume that I sell my previous goods. Okay, so you always need to go back and check which is the one that I still left. I will sell it off. That's why just now when I say that if you have high fluctuations, slow moving goods, you will have a problem, because if my goods move slowly, that means at the point of time when I have my new stock, I'm technically still selling my old stock away. And that is the problem, because at my financial statement, my P&L will reflect a lower COGS. But remember, lower COGS, it means that you have more profit. What does that impact you? First thing, more profit means more tax. But don't forget, you still have a bunch of stock remain in your warehouse. Those are the stocks that you are not sure whether you are able to clear or not, isn't it? I mean, given the situations. But of course, unless you are very sure you are using your stock moves very fast, just like what I mentioned earlier. If you have fast moving stock, either one, it works fine. Okay, now the next thing is, let's do a comparison. You see from here, if you look at the first in first out, okay, now when I have a COGS that is lower but my cost is high, you see my COGS should go higher. That gives me a more accurate reflections of what's going on in my inventory. So of course, although my closing stock may be lower, but at least I get the COGS accurate, isn't it? So at the same time, so if you compare with all this, I did the calculations already, if should be correct, okay? 6 out of 14 are higher compared with your first in first out. And the difference is actually not a lot. If you compare, like for example, 130, this is lower, 125, you have a higher COGS, of course. Then you have a lesser profit, which is good at this point of season, because at this season we are really not sure how the economy is going to work out, and then the inflation rate is going higher and higher. It seems that it's not really coming down very soon. So we need to buffer a little bit in terms of how we manage our stock. Okay, now if you look at it over here, 287.54, over here is 283. So if you compare from the values point of view, really moving average and first in first out are both accepted. So there's no such things as one is accepted or one is better. It just depends on the nature of your business. If you have fast moving goods, actually doesn't make a lot of difference. But if you have slow moving goods, moving average will be a better and more accurate way to reflect your true values in your inventory, isn't it? All right. Now, next thing I wanted to say, now if I sell everything, right, at the end of the day, my closing stock goes to zero. Okay, my COGS, you can see there's also a difference because of the previous purchase, the last purchase. Okay, now last purchase is $6. Oh my goodness, this is $7. So imagine if you have $7, 30 quantity, and then your COGS, it will still goes very low, because you can still imagine that, in technically speaking, I'm still selling my previous stocks. All right, so it gives me 85. Wow, very good. I'm still selling my previous stock. Here it shoots up to 104 when I'm using my moving average. So this is actual difference. So you have to wait. I mean, for business perspective, which one makes better sense for you? And one more thing is that I want to point out as well. For first in first out, it's really ideal situations, but doesn't really apply practically. Why do I say that? For example, I give the example. When we go to supermarket to buy things, ask yourself, do you usually take the front item, or some of us will dig out and reach out to the deepest place and grab the item? Why? Because it feels fresher and it has longer expiry date. So at this point of time, if this scenario happens, it's no longer a first in first out, because I cannot control how I move my items. But of course, don't get me wrong. I have a customer who die says that, I only work with first in first out, and they actually ISO that process of the whole things. So when I ask him, I say, are you sure you can keep first in first out? I say, no problem. We are very strict towards it. And they can do it because they food processing. So before I sell another batch of food to my customers, I make sure my staff sell everything on the plates first before I bring out another batch of food. So in that case, yes, first in first out, there's no problem with it. But not all of the business we are able to do that. Let's recap a little bit. Okay, this one. So fast moving, low fluctuation in cost, both works fine. Fast moving, high fluctuation, it's still not too bad for first in first out, because you are moving your stock very fast. It doesn't make a lot of huge difference as what you've seen earlier. And then the problem really comes is that the slow moving but high fluctuation cause. Then case, I find that first in first out doesn't really reflect current situations of your inventory. Okay, so that is my view on that. So in conclusion, okay, once again, so wrap it up, both actually fine. Okay, first in first out or moving average, it works fine. It's just that I find if you are talking about giving your reports a little bit more accurate, I find moving average will be a better approach. Okay, so I hope this session has been helpful, and please remember to subscribe to the channel so that I will have new videos and you will be notified. And of course, thank you so much once again, and we will catch up with you later. See you.